Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. Today's guest is Jacob Vanderslice. Jacob is a principal at VanWest Partners, a Denver-based real estate investment firm which focuses on the acquisition and management of self-storage facilities and other opportunistic real estate throughout the United States. He and his partners have acquired $300 million worth of self-storage since 2015. Jacob's background is as a firefighter and how he got into real estate investing while he was still working at the fire department, and how that morphed into a full-time real estate investing career in the single family space. How he acquired 1,200 units of single family investment property before he made the transition in 2015 to self-storage facilities, and has now, as I mentioned, acquired over $300 million worth of self-storage, and interestingly has sold off a portion of that portfolio for a pretty significant exit, over $100 million exit. And so I really enjoyed my conversation with Jacob today. He gave us some insights into how his business is structured, how it grew, the different components to his business, and the critical positions inside of his business structure. He has about 75 employees, which includes employees from his investment side, the property management side, as well as the commercial brokerage, and how all those businesses are integrated and work together. We talk about what's going on in the market today with all the economic turmoil, the interest rate challenges, and how he's navigating that. We talk about why he's decided to work on both the development of self-storage as well as value add single asset deals in the self-storage space, and some of the strategies that he is developed to acquire these type of opportunities, and also his mindset around holding these assets long-term moving forward, and some insights as to how he structures his deals and his thought process around not wanting to turn these assets over as fast as many would in the space, and holding them longer term. And so I think you're really going to enjoy the conversation we had with Jacob today. So without further ado, Mr. Jacob Vanderslice. All right, Mr. Jacob Vanderslice, welcome to the show. I appreciate you coming on.
Thanks for having us on today. Good to meet you over Zoom.
Yeah, my pleasure. So I've already given the listeners a little bit about your background and your experience, but why don't we just sort of go into a little bit more depth on that? Take us back. How did you get involved in the real estate space, and how did you get to where you're at today?
Well, many years ago, I was a professional firefighter, which means I don't work very much. You only work 10 days a month. So I started dabbling in residential real estate in my early 20s on my days off, and then got busy doing that and went full time into it. We started off by doing fix and flips. We've done a bunch of those all over the country. We did a programmatic JV with some institutional capital back when the big players got in the SFR space. And along the way, we did some adaptive reuse retail projects, some townhome developments, some multifamily repositions. And we had looked at self-storage for a while, and we liked its historic downside protection. It's durable income streams, its repeatability, scalability. And we got into the business in 2015, and we kind of got in big with a fairly large ground-up development deal here in Denver. Did a couple others in Denver, and then we expanded into the Milwaukee market in about 2016. We did some repositions out there. These were all funded with programmatic kind of joint venture equity and some LP equity. And we started doing single asset syndications and storage outside that partnership shortly thereafter. And we did our first storage fund in 19, and we closed that in 20. And then we did our second fund last year, and we're currently underway on our third fund. And we never really kind of sat down and said, let's be a self-storage shop. It was more, hey, let's do a deal and kind of see how it goes. And it went okay. So we did another one. And then over time, just kind of morphed into being as a primary line of business, a self-storage investor, owner, and operator.
And just for context, how much self-storage have you acquired since that first deal in 2015, just from a volume perspective, dollars perspective?
Well, we've done since 2015, we've done over 40 deals, over 40 self-storage facilities. We sold a large portfolio to Extra Space at the end of May for about 110 million. So that took our footprint down, obviously, pretty substantially because a lot of deals got sold and there's a lot of gross dollars that went out the door. So we currently have 35 facilities, and our assets under management total about 200 million.
Okay. So, and you sold off roughly 100 million. So,
Yep.
a little over 300 million total since you started in 2015. That's fantastic. Good for you guys. So I want to dive into a few aspects of this process for you. Your background was in the single family space. At least you got started there. And I have a lot of firefighter friends that are actually, in the real estate space here in Utah as well. So, that's a great gig for, on the site investors. You have 3 days,
Sure.
I think like 4 days on, 3 days off, or whatever the schedule is. Man, you got
Yep.
plenty of time to get out there and get after it. So good on you for getting started in that space. And then you made this shift in 2015 to self-storage. I'm interested in the formulation of your team. From what I can tell, you have four principals in the team, and correct me if I'm wrong on any of this, but you have four principals on the team. I'm curious, were all the principals involved in the single family investment company, and then did you all transition together? I'm just sort of curious about how this all came together for you guys, Bandwest Partners.
Yeah, it came together very organically and over many years. So initially it was just me and Aaron Westfall. He's a good buddy of mine. We go back to junior high, high school, college roommates. He quit his software engineering job in 2009 and joined me as a partner in our real estate investment strategy in the single family space. And we've been partners in everything ever since. And then Wade Buxton, our third partner, he actually used to work for us back in about 2010, and real smart guy, real estate MBA from DU, University of Denver. And he went to go work for another shop for a while. We reconnected on one of our first commercial deals, and we're like, "Hey, can you help us underwrite this?" He's like, "Sure." And I'm like, "Oh, by the way, can you put in some money? Because we're short on our capital." He's like, "Sure." I called up grandma, put some money in. That was our first deal we partnered on, and that was back in 2013 and 14. And then just kind of naturally evolved from there, and he became a full and equal partner, very talented guy. And then our fourth partner, John Sutterth, we've known him for a long time. And he worked for a big shop out of California, a big self-storage developer, owner, operator. And we had talked about partnering for a long time and just kind of never got around to it. And we finally put a deal together with him in October of last year in 2021. And he brings a ton of development experience to the shop. So he's leading our development line of business. So
Got it.
that's kind of the players. And in addition to them, we've got very talented folks in our operations team and asset management team. We've got about 75 employees across the entire company. Roughly 15 of them are in our Denver office, and the balance are scattered around the country, our various on-site managers, regional managers. So we've grown a fair amount, and staffing is very challenging these days, as I'm sure you're well aware of, especially in some of these smaller markets.
Yeah, that's a pretty common theme in our conversations with other sponsors is trying to find good people in the market that we're in today. Maybe that'll change as we move into this sort of recessionary period, but as of right now, it seems to be a common problem. So, so this is fantastic. You got the four principles organically coming together. Did I also see that you have an integrated brokerage as part of your business model? And I'm curious how that integrates with, what you're currently doing.
You chopped out for a brief moment. Are you talking about our property management platform?
Oh, I'm sorry. No, I thought I had seen that you also have an integrated commercial real estate brokerage as
We
part
do.
of.
We do.
Okay.
We do.
Yeah.
Sorry, you're loud and clear now, but just for a brief moment, I just missed the most important part of your question. Yeah, we do have a real estate brokerage. We were never, when we got in the business, we weren't real estate brokers. And we realized over time how much we were paying real estate brokers, frankly, for things that are not that hard to do. And I mean, if you calculate out their hourly compensation on some of the deals we've done over the years, it's kind of astounding. So we brought that in-house. So we really have really two lines of business inside of our real estate brokerage. We have some third-party tenant rep and transactional business. that Jay and Forrest run. They're two of my partners in the real estate brokerage, along with the rest of us. And then we also source our own deals in-house. So they do a fair amount of acquisitions. They also do the leasing for our owned retail asset base. We have a number of breweries and restaurants, yoga studios. So it's really just kind of complementary to the other things that we do. And it just frankly saves some money on the fee side by having it in-house. It's not a huge profit center, but it certainly is a big cost saver.
And is the brokerage business, or the agents or the brokers that are in that business with you, are they tasked with sourcing self-storage for you as well?
Yeah, they find storage deals. They found a fair number of our Fund 1 and Fund 2 acquisitions. They also do a lot of third-party work as well. They do their own investments on the side. They invest in our funds with us. So yeah, they're real estate entrepreneurs more so than they are real estate brokers.
Yeah, makes sense. Okay, so I want to push the conversation forward a little bit. You guys are based out of Colorado, at least headquartered out of Colorado. Obviously, I have employees in other parts of the country virtually, but based out of Colorado. Denver, is that correct?
Yep, you got it. We're just south of downtown Denver. You got
Okay,
it.
great. And what markets are you generally focused on as it relates to your self-storage investing?
Well, we've got two lines of business right now in our self-storage strategy. We've got our third fund, which is only focused on buying existing storage facilities that are undermanaged and adding value from operational efficiencies, from capital improvements. And then we also have a development line of business, which simply means we're buying raw land, we're getting it entitled, and we're building a brand new storage facility. And the two strategies are very different, and they're very different markets. So our development line of business is primarily focused on the Colorado Front Range. We just closed an acquisition about a month ago. We have 3 deals in the pipeline in the Denver metro area that we're closing on between Q4 and Q1. And then we also have some deals we're fairly close on in Austin, Texas, and Seattle, Washington. So the development business really targets high barrier to entry markets with deals that are very difficult to replicate, high barriers to entry from an entitlement perspective, from a cost perspective. Our acquisition line of business in Fund 3 and in Fund 1 and Fund 2, most of our deals and our acquisition efforts have been focused in the Midwest and the Southeast. So we're in Illinois, Michigan, Wisconsin, Ohio, North Carolina, Georgia, Florida, Arizona. Get a couple deals in the pipeline in Michigan, where we already own some assets. We've got some deals coming up in North Carolina, where we already are. So generally, these Midwest and Southeast markets, from a buying an existing facility perspective, we found have been a good blend of current yield, but also with capital appreciation as well. Development has almost no current yield. Most of the total return is on the reversion. So different strategies, different markets, but Midwest and Southeast in general. And we love the Colorado Front Range, of course. It's our own backyard, and we know the market well.
Yeah, makes sense. And so I'm interested, since you have both a value add and development background and experience, I'm curious if you can just chat with us about the nuances between the both. It seems that, in my experience, it's most common to have an investor focus on one or the other versus attacking both aspects. What are some of the challenges and opportunity that you see with both value add existing and also the development deals?
Well, I mean, the main delta is really between the two strategies. It's quite simply, it's risk and return profile. In development, the risk is obviously higher, but the total returns that we're targeting are also higher, and you need to be rewarded for that incremental additional risk. So, two options of the risk spectrum would be, we buy a deal, for example, we just bought a deal in Tucson in April, not just, but we bought a deal in Tucson in April, and the deal was about 93% physically occupied. We had a lot of historic revenue streams, but the rents were below market. The operating expenses were fairly bloated. Their advertising wasn't very efficient. So from a risk perspective on a deal like that, we know what our historic revenue streams were with the other ownership group. And in theory, we're a better operator than they are. So they're going to either be the same or they're going to get better, hopefully better. And they have so far. But you're buying existing historic cash flow, and that inherently is less risky. Now, on the opposite end of the spectrum is development. So, you've never had a storage facility at this location. You can underwrite rents and occupancies in competing facilities in the submarket and kind of trend those out over time. But your main risk in development, beyond the obvious, which is hard cost assumptions, right? We're in an inflationary environment, material, labor, it's all much more expensive than it was a couple of years ago. But your main risk in development, I believe, is forecasting those future revenue streams. And as we all know, revenue and NOI are so sensitive on your total value creation. If we're wrong in our forecasting by 10 cents per square foot per month on a stabilized revenue stream on a development deal, it's a material impact to the total project returns. So, I mean, to kind of distill a little bit further from an IRR and multiple perspective, on acquisitions, we're targeting a 14 to 16% IRR and a low 2 multiple over the life of the fund. Development, we're targeting an 18 to 20% IRR and a similar multiple, maybe a 2.25 multiple. But that's over a 5-year hold versus a 7-year hold. So the return profiles are different between each strategies, as I mentioned earlier, simply because of the subjective and objective risk of building something new versus buying something existing.
And did you choose to go into development and value add strategically from a perspective of, hey, we want to be able to have deals that we can present to an investor network that are a little bit lower risk, a little bit higher risk, have a different blend of return profiles and hold lengths? Or was it just opportunistic? It sounded like the very first deal you got into was a development deal, if I understood you correctly. And then, so I'm just interested in the overall philosophy of why attack both.
Well, as we've acknowledged, we've developed a fair amount of storage over the years, but we haven't done ground up development for a while. And the reason was we just didn't feel like the markets made sense. Rents had not come up enough to support a new construction cost basis. And in the last year, really in the last 6 months, we've had a major reduction in the supply pipeline for new development. And cities have pulled back heavily on their allowed uses for storage. So it's more difficult to get them entitled than it used to be historically. So we felt like kind of all the stars aligned in that it makes sense to start building again in these undersupplied markets with a very low supply pipeline. So the opportunity made sense. And we also have a fair number of investors who don't really need or want current cash flow. They want growth and they want a higher IRR over a shorter period. So those development deals kind of cater to those investor types. And the reason we're doing our development strategy outside of Fund 3 is really simply because the strategy is too different, as we acknowledged earlier, too different from buying existing facilities. If you layered in development into the same fund that's buying existing facilities as well, the return profile would be substantially different from a cash flow expectation, right? If you lay out $5 or $10 million in equity on a development deal, that's going to have no income for years. And it's going to drag down your ability to distribute from cash flow from other deals that are producing cash flow. So that's why we kind of separated the two out and reinvigorate our development strategy, just because the timing makes sense.
And from an investor standpoint, I'm curious about the interest from your investors or participation from your investors on both models. Have you found that your investor base has wanted to participate across the board? Have you found some investors that lean towards the development fund versus the value add fund? Obviously, it's going to be dependent upon their particular needs and what they're looking for, from a risk and return profile. But I'm just curious, in a general sense, have you found that your investor base is interested in both and blending their returns through both funds?
Yeah, it really depends on the investor. We have a number of different investor types. We have kind of retail investors that they hear us on a podcast or they find us online, whatever the case might be. They fill out a web form on our website. They sign subscription documents. We have guys who've been with us for 10 or 12 years who are always down for $100,000 or whatever we're up to. A couple examples though. So we closed a development syndication, as I mentioned, about a month ago. That was about $5.5 million in equity. And at the same time, we're raising capital for Fund 3. So we had a few guys who wanted to make a $200K allocation to us, just for example. And they might have done 125 in Fund 3 and 75 in the development project. Other investors don't want to be in funds because of kind of the wider buying box. A fund is more of a strategy than a deal. And sometimes it's harder to raise money for a strategy than it is for a deal. And
Right.
when you're raising money for a deal, that caters to the folks who really want to pick and choose the locations they invest in. So you have a number of investors who are in our development syndications who do not want to be in the fund because they want to just understand and be a little more intimate with what their capital is attached to. So really it varies
Yeah.
across the board, but I would say most folks did a little more in our fund strategy, a little bit less in our development deals. And some have done a lot in our development deals and none in our fund, and some have done a lot in our fund and none in development. So
Yeah.
it kind of
Makes
runs the
sense.
gamut.
Yeah. Understood. So, what's the end goal with VanWest Partners? What are you guys trying to accomplish long term as it relates to just an overarching strategy over the next 5 to 10 years? What does this look like for you?
Yeah, I mean, this might get philosophical for a moment, but what's the definition of wealth, right? A lot of people have different definitions on what wealth means. And one of the many mistakes that we made in our real estate careers is being overly transactional. And by that, I mean buying, making better, and selling too often and too quickly. And we concluded way late in our careers, but about 4 years ago, we concluded that our definition of wealth in real estate is building a sustainable asset base that's responsibly financed that creates recurring revenue streams over and over and over again. So our thesis really is continue building this portfolio that's a cash flow machine, enjoy those repeatable, durable revenue streams from the operational cash flow the portfolio produces, and when appropriate, monetize that value. And monetizing that value could come in the form of a refinance, replacing investor equity with bank debt. It could come in the form of a recap, rolling up all of our portfolios and giving folks an option for a liquidity event, or rolling up into NewCo and enjoying the income. And it could involve simply an arm's length sale on the open market, strategically on assets with a lot of value. But our end game really, we don't like, again, buying, making better, and selling quickly. We like to buy, make better, and hold for cash flow and monetize when appropriate. So generally, our goal as sponsors and for our investors as well is cash flow, just repeatable, recurring revenue streams.
And this comes on the tail of a pretty significant exit for your company, right? So, is there an argument to be said that this is the philosophy or the strategy after one has a big exit like that? Because you probably wouldn't have been able to grow, you wouldn't have had the grow as fast. Obviously, a lot of these syndication companies want to sell within 3 to 5 years because they have a big influx of cash that helps them grow significantly and get quality people on their team to help them go and achieve what they're really trying to achieve in the long term. If you had gone out the gate with the strategy of more of a long-term hold cash flow machine, minimizing exits as much as possible, could you have accomplished what you've accomplished thus far?
The round trip that we did, the majority of the equity in that portfolio was a life insurance company out of Texas and some high net worth guys here in Denver. We were co-GPs with them. And their strategy is turning. They like to see reversions. They like to see multiples. They like to see round trips. They just want to keep their capital churning. I think that portfolio, our track record in building that and exiting it, certainly helped raise other capital for our strategy. But now that the life insurance company has realized a good multiple, they're out of the storage portfolio. Most of our investors in our capital base, they want that long-term cash flow. They're not expecting a quick turn. So I think for the foreseeable future, that's our intention. Just finance stuff responsibly, keep building. But people want to see round trips. And if you haven't had a lot of round trips, it's could be difficult to raise capital sometimes, even if you haven't intended to have a round trip. People want to see exits, and that certainly helped.
Yeah.
As far as, hey, this portfolio was built over 15 and 16. We held it. We sold it in 2022. These are the returns. Jump in with us. We know what we're doing.
Yeah, definitely helpful. The track record definitely helps bring in the equity needed. Moving forward, let's talk about the biggest challenges that you're facing today. Obviously, your business looks different than it did, back in 2015 when you got started in the self-storage space. But what are the biggest challenges that you're facing today in the way that your business is structured, or the current environment?
Well, the current environment, as we all know, is very dynamic. We always knew interest rates were going to go up this year. We have a lot of fixed rate debt, thankfully, that we sourced in Q1 and throughout 2021 and before. 10-year fixed financing, long-term interest only. But the capital markets have changed substantially, even in the last 2 weeks. We're recording this in almost
Late
late
September.
September. Yeah.
Yeah.
And, even this month, it's been a material change. So that's one challenge that we're looking at is the rising rate environment that we're in, and when, not if, but when that's going to impact values. And what we don't want to do is identify when that value impact occurred in the rearview mirror. We don't want to say, oh, a year from now, that value impact was obvious in November of 22. We want to identify when that's happening real time. And it's tough to do because the market's so dynamic. But do the math, right? You can't pay a stabilized 4 cap on an acquisition and finance it at a 6 or a 6.5. Just the math doesn't work. Now, there's so much equity that wants to be in this business, given what it did during the pandemic. It performed well during the financial crisis. So put quite simply, there is more demand than there is supply. And that demand, that investor demand right now, is still keeping cap rates fairly compressed just because so many people want the product type. But that's going to change, I think, really soon because, again, the math is just going to break as the cost of capital rises. So that's one big challenge for us. Forecasting out our debt assumptions and acquisitions that might not close until December. What are you putting in your model for your interest rate, right? I mean, whatever you put in, you're probably going to be wrong.
Right.
But you want to be wrong in the right way and not the wrong way. So that's challenging, and it's going to impact our dividend yields, our total return profiles, until we start seeing bigger discounts and sellers kind of coming to terms with the fact that my deal might have been worth a 4 cap last year, and now I need to accept that it's not. So we're hopefully going to be able to source some opportunity as values decline. We're not seeing this happen in a meaningful way yet, but it's got to be coming up really soon. So interest rates and just watching values come down are definitely a challenge as things change. And then another big one too, generally, is staffing. We have a lot of employees who are wonderful, but they're making 16 to 18 bucks an hour. They don't stick around very long. We're working on really hard on retention. Some markets that we're in that you wouldn't expect are just really tough to hire in, like Columbus, Ohio, is really tough to find talent. A few submarkets in Michigan are kind of similar. But like Florida Panhandle, we have some amazing employees down there, have been with us for a long time. So staffing challenges are certainly out there. But as we continue into this recessionary environment and unemployment's inevitably going to go up, hopefully that'll kind of shake up some town a little bit better than it has historically. But yeah, just the cost of capital and finding good people are 2 big challenges right now that we have.
And what do you see as the greatest opportunity for you guys moving forward? What are you on the horizon? What do you see? Is it this shift in this sort of standoff between sellers and buyers and values coming down? Is that the biggest opportunity that you see moving forward?
Yeah, and again, we're not seeing obvious signs of this yet, but we've seen a lot of models out there and OMs that, frankly, I believe have untenable underwriting assumptions, and they're showing a few things in these models. One of them is really aggressive revenue growth. We saw aggressive revenue growth during the pandemic and in the quarters thereafter. Not that we're totally out of it, but we pretty much are, I think. Who knows? You can't really take that historic revenue growth, though, and extrapolate that on a go-forward basis. So we've seen some very aggressive revenue growth assumptions, and we've seen a lot of IRR games being played with short-term refinances. So if you, in your model, if you show a refinance with a 50% return of capital on year 2, your IRR is going to be materially higher than if you weren't showing that. Well, predicting that refinance happening, when, what are the proceeds, what's the interest rate is very, and it's impossible to do. So we've seen a lot of models that rely on that refi for an IRR boost. And third, what we've seen pretty consistently are what we believe to be untenably low exit cap rates in a short amount of time in secondary and tertiary markets. So if you pull all those levers, you're going to show a really good return and a good multiple. But if one of those things don't happen, chances are the other two probably won't happen either. So that's a long-winded way of saying I think we're going to start to see some deals under some duress. Even though storage has performed really well during economic downturns and dislocation events, I think some excessive premiums have been paid for a number of properties over the last year or so that are probably going to have some performance issues in the short term. So the opportunity is going to be hopefully finding some duress in the market and being able to capitalize on that and potentially solve a seller's problem at the same time.
Yeah, great insight. So you guys have built a substantial business, 75 employees. I assume that the majority of those employees are on the property management side of things. Is that correct?
They are, yeah, roughly 60 out of the 75
Okay.
are field personnel.
So for someone that is in the stage of growth and they're really looking to start hiring at this point, now granted, you have a few facets of your business. You have the brokerage business, you have the investment business, and then you have property management side. But for someone that's growing outside of the key principles that you have in your company, what's the most important role in your companies that that creates success for your company? Like, what's that most important critical role inside of your businesses that helps you to achieve your goals?
Well, I think a real estate investing business needs three things. It needs capital, it needs deal flow, and it needs operations. And I think the most critical of those three, historically and certainly looking forward, is the operations side.
Mm.
So not anybody necessarily, but most folks can go out and find the money and find the deal. But it is up to your operations team to execute on that business plan. We're going to hold these things for a number of years. And our return profile and our return targets are entirely driven by our ability to execute on that business plan, which is growing revenue, growing NOI over time, controlling expenses. So I think operations, especially in this dynamic environment, are absolutely critical. Running your portfolio lean, efficiently, being diligent about your revenue management, responding real time to supply and demand changes. All these leases, as you probably know, are month to month, right? They're not 10-year industrial leases. These are month to month self-storage leases. And if you're having low occupancy, you can course correct pretty quickly by dipping your rates down and filling your units up. And likewise, if you're full, you can raise rates over time and probably not get very many move outs. But yeah, once again, it's I think operations is the most important aspect of our business, and capital raising and underwriting acquisitions are obviously important too, and all of them go hand in hand, right? Your acquisition assumptions in your model have to be achievable and reasonable, and it's up to your operations team to accomplish those goals and operate our properties to the model or better. But yeah, running the portfolio is absolutely the most important piece of our business.
Love it. Well, look, Jacob, this has been a great conversation. I really enjoyed hearing about your business, how it came together, your background, in as a fireman, getting started in the investment space in the single family world, and a tremendous amount of experience there, over 1,200 homes bought and sold, and then your transition into the self-storage space. And thank you for giving us some insights about your business, how it's structured, what you guys are focused on, and why. And before we end here, for the young lead sponsors out there, the up and coming lead sponsors, what advice would you have for someone who's just getting started in this space under the current economic conditions?
Well, if you haven't done a deal yet, but you want to, you have this idea to go call up a couple buddies and syndicate something, but you're not finding the perfect opportunity right now, my advice is take action and take risk. There's never any wealth created by sitting on the sidelines. We thought about, I mean, I'm sure you were as concerned or maybe even panicked as we were in March and April of 2020. And we sat down and said, do we stop? Do we just terminate all the deals we have in the pipeline? I mean, the world could be completely different here in a few months. Do we stop? And we decided not to. We're going to keep going. We're going to be responsible. We're going to make reasonable assumptions. So I think my advice is just take a risk. There's never a perfect deal. There's never a perfect market, but in up markets and markets that are coming off the rails, there's always going to be an opportunity. You just have to mitigate the downside as much as you can. Tell yourself the story of how you lose and how difficult it's going to be to lose, and also reasonably quantify the upside. But take a risk and do a deal.
Love it. Well, Jacob, again, a pleasure to have you on the show. Thank you for sharing your insights with our listeners. Before I let you go, what's the best way for our listeners to get in contact with you guys and learn more about VanWest Partners?
Yeah, people can email me, jacob@vanwestpartners.com. Go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Perfect. We'll have those links in the show notes. So if you've enjoyed our conversation with Jacob today, go down in the show notes right now, click on one of those links to connect with Jacob and his team. And Jacob, again, an honor to have you on the show. I appreciate it, and I look forward to staying in touch down the road.
David, enjoyed it. Thanks for having us on today.